The simmering tensions between Russia and Ukraine have kept global equities under pressure for days now. Sliding for the fifth consecutive day, the BSE Sensex dropped 383 points, while the Nifty 50 fell 114 points to settle the day at 58,300 and 17,092 yesterday. Earlier in the day, both these indices have cracked around 1,300 point and 400 points respectively in intraday trade. The developments in Eastern Europe roiled global markets as investors monitored the implications of potential sanctions against Russia and the latter's counter move, if any. We have Ambarish Baliga with us, who is an independent market analyst, to suggest what possibly lies ahead for the markets.
The global environment is getting risk-off with uncertainty on the Ukraine front. Inflation, tapering, and series of Fed hikes is something the markets are getting prepared for. Closer home, in fact, we have two major events: the run-up to the state elections, results being declared on March 10th. I think the markets will be nervous till then, and then finally will react to the outcome. And more importantly, the LIC IPO, which is scheduled to open in the second week of March, hopefully close by March 14th. I think this will suck out a lot of liquidity. And additionally, we also have advance tax payments on 15th of March. I think that will be a further drain. So expect a decent correction, which will be led by liquidity crunch among the domestic investors, continuous selling by FIIs, and lack of positive news flows.
Back home, investors have lost a chunk of their wealth as the benchmarks have skid around 1.5% so far this year. The broader mid-cap and small-cap indices, meanwhile, have dropped up to 13% during this period. Given this, Dhananjay Sinha, Managing Director and Chief Strategist at JM Financial Institutional Securities, says retail investors should remain cautious and look at quality large caps for now.
For the retail investors, I think they have been fairly exposed to the small cap and mid cap liquid stocks. I think there is a high risk of price erosion. So basically, in the mid cap, we are saying, one has to be cautious. There will be companies that are good and have liquidity in terms of the trading along, because the risk to price is very high. So I'm we are looking at large cap exposure, there is liquid stock, etc. So basically the approach should be sort of cautious, because we think there is a sort of downside even for the benchmark index. So those are the broad things that sort of everyone is looking at. So be with companies that have long-term growth outlook and which is strong, and be with those companies, and because we think that the market is overvalued, it is expensive. So we need to have a good combination of valuation and the companies that you're investing in terms of growth outlook, etc. People who have companies that have low risk to margins and profitability.
Baliga too says retail investors should use any bounce back to get back into cash.
Retail investors, I think, should try to reduce positions, as it will not be a one-way down sort of a market. So utilize bounce backs to get back into cash. I think we should get enough sort of investment opportunities over the next 2 to 3 months at more attractive levels. The sectors which I think are worth looking at for investment at lower levels would be infrastructure, cement, automobiles and ancillaries, FMCG and pharma. The new age stocks could possibly provide you a decent amount of trading opportunities, but for investment, I think I'll stay out for the time being.
That said, from a year-long perspective, Sinha says the year 2022 could be a year of flattish returns with downwards risks weighing more. And he may not be the only one with this view. Multiple headwinds in the form of Russia-Ukraine crisis, Brent crude oil price at $99 a barrel, prospects of faster than expected hike in rates by the global central banks and its impact on bond yields, impending state elections in India, and the fears of a rise in inflation has seen foreign brokerages recalibrate their return expectation from the markets in 2022. Thus, Jefferies has cut its December 2022 target for the Nifty 50 to 17,500, which is around 3.5% higher from current levels. Its 10 mean reversion scenarios put the Nifty 50 December 2022 in the range of 16,500 to 18,500 amid near-term risks, including threat to liquidity due to LIC IPO, continued foreign selling, and a perception that the RBI might be behind the curve amidst the twin deficit concerns. BOFA Securities too has cut its December 2022 Nifty target to 17,000 from 19,100 earlier. Thus, calendar year 2022 may give tepid returns to investors after 2 consecutive years of double-digit gains as outlook for the markets remains indefinite.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.